consumer inflation ticked up slightly in January, but remains well below the midpoint of the Reserve Bank's inflation target band. Stats SA data shows consumer price inflation rose by 3.2% in January on a year-on-year basis. That's up from 3% in December. The main contributors to the annual inflation rate were housing and utilities, food and non-alcoholic beverages, as well as restaurants and accommodation services. Despite the slight increase, inflation remains low, perhaps keeping hopes of another rate cut. Food and non-alcoholic beverages inflation declined slightly to 2.3% in January from 2.5% in December. The categories that recorded higher price changes were hot beverages, sugar and fish. In the housing and utilities category, electricity, gas and other fuels recorded the highest price change. Well, for more on this story, let's bring in Nicky Weimar. She's the chief economist at Nedbank. Thanks very much, Nicky, for joining us. So this is pretty much in line with what the market had expected. What were the key takeaways that you drew from this latest print?
I think the key story here is that you still have very subdued food inflation. If you strip out of the component food and non-alcoholic beverages, the bulk of the upward pressure came from non-alcoholic beverages, whereas food inflation actually ticked down again to 1.5%. So it's pretty low, pretty contained. If you then look at core inflation, which excludes volatile food and fuel prices, you also have a very benign picture of inflation staying pretty steady at 3.5%. So if we look at all of this, you still got inflation well below the Reserve Bank's target of 4.5%. If you look at the entire basket, there doesn't seem to be any category where we're seeing very significant upward momentum coming through in prices. So everything is pretty contained, pretty subdued. And I think that's the key takeaway from today's numbers.
Yeah, but just on the issue of food price inflation, if we look back to what happened last year, this time last year, we saw that prices began to tick up because of weather events in South Africa, crop failures, etc., etc. What is your expectation going forward, all things being equal?
All right, so on food prices, we've expected for quite some time that it should start ticking up. If you look at global food inflation, it's still low, but it was falling throughout last year, so it was negative throughout last year. As we came towards the end of last year, the cycle seemed to turn, and so your declines got shallower and shallower, and then around December, it started turning positive, and that continued into January. So global food prices are starting to rise, off a very low level, but it is rising. You've had the rand generally a bit weaker, and then you've got this unpredictable situation around weather. Now, from our analysis, it certainly suggests that drought conditions do a lot more harm than flooding. At the end of the day, agriculture is far more severely affected when you have drought than when you have heavy rains and potentially with that flooding. So this also bodes well for food inflation. So you've got this upward pressure coming from the rand, you've got the upward pressure coming from global food prices, but you still have a fairly favorable agricultural situation domestically with some late planting, which could maybe put some downward pressure on the prices.
Yeah.
Our view is that food inflation will tick up, but very modestly.
Right. So as the Reserve Bank governor has warned at the last MPC, are you seeing more inflationary pressures on the horizon, essentially due to US trade policies?
Well, this is an ever-evolving thing, and it's not settled yet. We see it's sort of coming through in drips and drabs, a lot of threats, but if you look at what has actually been enacted in the US on the trade front, which is really the bit that have implications for the rest of the world, that is around tariffs. You've had very significant tariffs slapped on top of China. So there's a 10% increase in all import tariffs from China into the US. China matched that much more strategically. They didn't put a universal increase in. They focused really on goods that were strategically important for the US. Then they have also gone with a 25% tariff on aluminium and steel. This is on top of the tariffs that were already raised during the first Trump administration and kept by Biden. And now they're talking about reciprocal tariffs. Now, this is an absolute nightmare. There's over 30,000 product categories within the harmonized system. They might all have different tariffs in different countries. So, if that triggers retaliation, that's when it will start to affect our price dynamics, start to affect global trade, and potentially feed in to higher inflation domestically. So it's not settled, but clearly it's uncertain. I think the bigger concern for the Reserve Bank is obviously the outlook for the rand. With US inflation clearly being sticky, that certainly has been the case the last 4 months, ticking up even a little bit in January on both core inflation and headline inflation. And with the US Fed signaling a pause, that could put pressure on the currency. It does make it harder for the Reserve Bank to cut interest rates aggressively without, say, putting pressure on the currency. So it's really the worry about how US inflation and monetary policy will impact on the rand. We have too little information to make any judgment on how trade and the tariffs will play out at the end of the day.
No, well explained, Nicky. But let me ask you the very pointed question. You're sort of alluding to it, the pointed question of what you think the Reserve Bank will decide come March then.
If I look at the statement they put out in January, it was definitely very, they cut rates, but almost reluctantly, if I can put it that way. And much of the statement was a warning about a very uncertain global environment that could hold implications for the currency and for South Africa's inflation. They even illustrated this whole scenario they've built around the potential impact of a trade war on inflation, which is significant based on the scenario they were presenting. So they focused really on the upside risk to the inflation outlook. And that suggests to me that they are on a cautious state of mind, that they consider the risk just too significant. And our view, therefore, is coming March, they're probably going to pause. But based on today's inflation numbers, unless something dramatically changes, and bear in mind that the rand has actually stabilized a bit, and it's been pretty steady given the volatility in the global setup, and the increase in geopolitical risk and all that, the rand's held fairly firm. So in our view, the numbers at this point still support another cut of 25 basis points, but we just don't think it's going to come in March.
Yeah, well, we're hopeful about that. Let's do a short left. Of course, you're an economist and you've been keenly keeping an eye on the non-event that was the budget last week. What's your sense around what that March budget is going to look like, given the fight over VAT and seemingly, what we're hearing in terms of leaks from the discussions? It seems as though VAT is now off the table and they're still trying to find a way forward. Do you anticipate that we're going to see a more austere budget, that we're going to see, rather than, these massive spending commitments that we saw in the budget that wasn't, more cuts than actual more spending?
Well, I think that's really then, if you want to reduce the deficit, which you have to do, because that's what foreigners still fund a big portion of South Africa's government debt, and they will be looking at specifically whether we can move our government finances to a more sustainable footing. And let's not beat around the bush. We are on a completely unsustainable position. We've had over 10 years of really running deficits of over 3% of GDP. In that period, we have added to our debt burden at a very rapid rate, to the point where it is now 76% of GDP, and in 2009 it was only 26% of GDP, and we had considerable fiscal space. So we've wasted all of that. So the question now is, what can we do in this tight position to support the economy and still at the same time move government finances in the right direction towards a more sustainable balance between revenue and expenditure? So I think that is the trick. You can grow your way out of it. The problem for South Africa is that we can't, because of structural constraints. It's a little bit of a catch-22. to. We've got these structural constraints, which mainly reside in economic infrastructure, that being electricity, rail and port issues, as well as water. And they are keeping a lid on the extent to which this economy can grow. And the people mainly responsible for lifting that constraint is, in fact, the public sector, mainly through state-owned enterprises, but also at a municipal level. So that's general government. So you do need increased infrastructure spending, which government already made an allocation for in the mini budget last year. But then they cut other spending, or they kept it very steady. Now, the budget that never came to be allocated more towards consumption expenditure, especially towards the social wage. And then clearly they found themselves with quite a big deficit, and they had to crawl it back through higher VAT increases. So if that is off the table, our only option really is to cut spending. And I think given the constraints in the economy, that should not occur in infrastructure spending. You want to move to a position where we can grow faster. So you really want to be looking at consumption expenditure, and you really maybe, rather than offer above inflation increases on the social wage, just line it up with inflation, because in real terms then you keep your expenditure flat.
Yeah. Nicky, we're going to leave it there, but thank you so much for your time and insights there. That was Nicky Weimar. She's the chief economist at Nedbank.